Good afternoon, ladies and gentlemen. My name is Simon Mills. I'm a Senior Associate at the Zen Group, and I'd like to welcome you all to today's FS Club webinar, where we're going to be discussing nature-based finance using bonds to restore the planet. I'm joined by Peter Elwin, who's Director of Fixed Income, and Francois Mosnier, who's Head of the Oceans Programme at Planet Tracker. Peter Elwin has over 20 years of financial markets experience in senior management and functional roles on the buy side and the sell side, whilst Francois brings more than 10 years of experience working across finance, nature conservation and sustainable farming. As always, the agenda for this webinar is very simple. Following my introduction, our speakers are going to make their presentation and then we'll move on to the Q&A discussion. I'm afraid that you're all muted, but you are able to submit your questions through the chat tool to the right of your screen. Please do chip in at any point of the proceedings. I'm going to be collating your questions and we'll put them to Peter and Francois at the end. As with all of our FS Club webinars, we're going to be recording this session and you'll be able to access the slides and the presentation at a later date. Now, before we move on, I really must thank FS Club members who've opened up our webinar series to the public. With their help, since March of 2020, we've held over 300 of these events on topics as diverse as money laundering, the metaverse, and high salinity agriculture. The FS Club is the premier global executive knowledge network for technology and finance, where members and their guests can meet over a glass of wine to debate key issues which impact on financial services, technology and society. It's very much a 21st century version of the city's 17th century coffee houses. And so, without further ado, I would like to introduce the first of today's speakers. Peter, tell us about nature-based finance.
Thank you, Simon, and thank you to everybody who's dialed in. It's a pleasure to be with you today. So Francois and I are going to be talking through a couple of examples of nature-based finance. I'll talk about a deforestation-linked sovereign bond, and Francois is going to talk about an ocean-linked blue bond, but we'll come on to that in a minute. What I'd like to do first is just briefly give you a bit of background to Planet Tracker itself, which is the organisation that we both work for, and then talk a little bit more about nature bonds broadly before going into the sort of the specifics of the two examples. So Planet Tracker itself is a non-profit organisation. We're a financial think tank, and ultimately what we are aiming to do is to change behaviour in the financial markets so that they take into account the things that from an economic perspective are currently branded as externalities, but as we all know from day-to-day life are actually essentials like air and water, safe land to stand on and not get flooded by, and so on and so forth. So the nature that surrounds us is absolutely fundamental to our very existence, and therefore also fundamental to our economy as well. And Planet Tracker's aim is to get the financial markets properly taking account of those natural boundaries that we have to work within and the natural capital on which our whole economy actually is based. So you can see there slightly better pictures than the people who are actually in front of you. We were nicely brushed up both physically and also with I suspect some software package. So those are your two speakers. We can jump on to the next slide. So that's the agenda. We'll talk about nature-based finance, talk about a deforestation-linked sovereign bond, and then a corporate example, the blue recovery bond. So we can now move on to look at nature-based finance itself. On the next slide, please. Now, very simply, nature-based finance is any financial instrument which is linked in some way to nature. So that's a very, very broad definition. More specifically, you will find that the instrument is linked to nature in terms of outcomes, so what you're actually trying to achieve through the finance, or, and it might be both, it might be a combination of the two, it's linked to a natural asset which is used as collateral for the funds raised. So a very, very broad term indeed. Now, if we jump on to the next slide, we can drill into the terminology that's used in this context in a little bit more detail. As always, many of you working in the financial markets will know that the financial markets are never short of an acronym or a piece of terminology. The more the better. And unfortunately, the sort of sustainability finance area, nature-based bonds, that is just another example where there's been an absolute proliferation of different terms. And it can be quite confusing, and as always, the terms are not always used in a completely consistent way. But for the purposes of today's webinar, the way that we are looking at bonds, we can call them ESG-labelled bonds, if you want, as an alternative to nature bonds. We're splitting them into two broad camps. Bonds where there is a restraint or a constraint around the use of proceeds, often referred to as green bonds, if they have a green purpose, like funding renewable energy, or a social bond if it has a positive social outcome as the design within the bond, or possibly a sustainability bond where it's a combination of green and social. The alternative, or the other sort of part of the family tree, if you like, what you might call performance bonds, where you're not restricting the use of proceeds. You're actually looking at the way that the bond works and the way the organization issuing the bond actually works in terms of its sustainability ambitions. So the bond is linked to the performance of the organization actually issuing the bond. Now, if you look at the next slide, you'll see on this talking about the use of proceeds, green, social, or sustainable. This is probably at the moment the most common form of ESG-labelled bonds, but one would guess that it may actually become slightly less common for reasons that we'll see as we go through. So here the borrower is promising to use the proceeds for a particular purpose. That's a contractual obligation. If you fall down on that, you can be sued by the investors. Now, that obviously means the project has to be evaluated before the issue of the bond to make sure it satisfies the constraints, the criteria. You prefer to have an independent opinion around that. And then you'll need a monitoring process to make sure the proceeds are being used as they were intended for, and that is then reported on. Similarly, the amount borrowed must not exceed the project spending. That's quite an important constraint. So you can't over-borrow. You have to under-borrow in relation to the size of the project. So that sets a limit on the amount of money that can actually be raised, on the size of the issue. It has to relate to the project, which might or might not be an unhelpful situation for some issuers. And certainly for small projects, that would result in a small bond issue, and you tend to find then that the costs outweigh the benefits, and investors are not necessarily that interested in dropping their money into something that would constitute far too small a part of their portfolio, and the post-event liquidity would not be really to their liking. So there is a lower limit on the sort of the project size that tends to work for a use of proceeds bond. Now, a sustainability-linked bond, on the other hand, on the next slide, a sustainability-linked bond does not have these constraints. So the use of proceeds is unrestricted. It's just like a normal bond in that respect. So you borrow the money, you can then spend it on any general corporate purpose. You could, of course, if you wanted to, spend it on a green or a social purpose, but you don't have to. You can mix and match. So there's that inherent flexibility, which is much, much more attractive from a corporate treasurer's perspective. Now, the difference with this bond is that now the interest rate, the coupon, is linked to your performance. So the coupon is to some extent variable. It's not variable in the way that a normal variable sort of loan note might vary on a 3 or 6 monthly basis, stepping up or down with the yield curve. This is variable based upon specific milestones set out in the bond contract. You will set a target, a sustainability performance target, as it's often referred to in the bond terminology. You will set that prior to the bond issue. If you meet or beat that target, then the interest rate may stay the same or might even fall. If you fail to meet that target, then the interest rate will go up. So there's a financial sort of incentive built into the structure of the bond. And there are some principles, as you would hope, around the sort of the broad structures of these bonds that set out how you should measure the sustainability performance target, how you monitor it. Generally, again, you'll want external verification. And of course, investors will want some sort of reporting to explain what's actually going on so that they can get a degree of visibility around what's actually happening in the bond. If you look on the next slide, you'll see a sort of slightly clearer visual diagram of how the coupon can alter. The left-hand side is what you might call a more traditional sustainability-linked bond, where there's simply one measurement point and one step up, often 25 basis points for no particularly good reason other than that's become sort of rather accepted market practice. and that will then stay for the rest of the life of the bond. So if you've got a 7-year bond, you might have a step up at the end of year 4, and for the final 3 years, you'll be paying an extra 25 basis points on your coupon. Now, theoretically, nobody's actually done this yet, but theoretically, there's nothing to stop you having something that would look perhaps a little bit more like an inflation-linked bond, where the coupon actually stepped up or down at periodic intervals, depending upon the underlying performance. So if the company or the organization, a sovereign, misses a target, the coupon steps up. In the diagram on the right-hand side, that's happened twice. You have a period of a high coupon, and then they actually meet the sustainability target or beat it. The coupon then starts to step down. So again, there's a financial incentive built into the structure and more sort of flexibility. Now, in terms of using sustainability-linked bonds in a sovereign situation, there are a number of questions that sovereign issuers actually have to think about when they're structuring a bond like this. Now, one of the most obvious ones is, okay, so I've failed to meet my sustainability performance target, so my coupon's stepping up. Who gets the penalty payments? You could have a rather unfortunate situation where you've got an emerging market economy. They've said they're going to meet a sustainability performance target. They failed to do so, and then suddenly they seem to be paying extra money to sort of rich pension funds based in the global north, and that might not seem like a particularly attractive sort of set of optics. You could structure it to pay it to somebody else. We'll come on to that in a minute. You could regard the step up as actually a legitimate reward to investors. So they funded this sustainability sort of linked project, and this is essentially a hedge to them against the failure to achieve the target at that particular point. So there are a number of arguments that you would need to think about, and they would all have to be discussed during the bond issuance process. Now, clearly a step down sounds much easier to sell. So you can say to your voters, we've issued a bond to those rapacious pension funds in the global north. We're pretty sure we can meet the sustainability target. Lo and behold, we do. And oh, look, we're paying less interest to all those rich fat pensioners and saving you money because you've helped us to achieve our sustainability target. So that's definitely an easier political sell, and certainly gives some sort of, if you like, buy-in to the populace, to the economy of that country in terms of helping to achieve that target. There is something else to think about, though, in a sovereign context, and that is, again, imagine a country like Brazil, for example, or any other number of countries around at the moment, a country like the UK, where you've got an election coming up. So we've got one coming up in 2024, and Brazil, it's obviously coming up this October for the presidential election. You could imagine a scenario where the government issues a sustainability-linked sovereign bond with, say, a 7-year time frame. The coupon step up or down is beyond the election sort of horizon, and maybe they feel actually their chances of winning are not that great. So they could really tie the hands of a future government by imposing an unrealistically tough target on them and creating all sorts of problems. So there's some question marks around electoral games that might be played within a sustainability-linked structure that, again, would potentially have to be addressed. And that's actually where multiple step-ups and multiple step-down possibilities fit more neatly with an electoral cycle, and potentially crossing several electoral cycles if you're thinking of something like a 10-year bond. Okay, what else do we need to think about? Well, let's have a look at a specific example of a sovereign bond linked to deforestation. So this is a sustainability-linked bond issued by a sovereign, and the sustainability performance target we're going to look at is deforestation. Now, as I say, this would be a classic example for a country like Brazil or Indonesia or another country where deforestation is regarded as a sort of large systemic issue, something that the government wants to tackle, and where there could be merits in building a financial incentive into their bond sort of market structures in order to achieve that. Let's have a look at the next page just to put this into context. So deforestation-linked sovereign bond, so it's within the sort of the family of performance bonds. It's not novel in terms of its overall sort of conceptual framework. Michael Magnelli of this parish was talking about policy performance bonds back in 2005. Various other people have talked about sort of nature performance bonds. The World Bank actually talked about sustainability-linked performance bonds in a sovereign context. So we're very much building on that sort of that family tree, standing on the shoulders of giants, as it were. But we think this deforestation bond has a lot of interesting aspects to it. If you have a look at the next slide, you'll see a classic sort of investment bankers flow chart, which they love to roll out when pitching to investors, which makes the whole thing look very simple and very attractive. In essence, it is pretty simple and could be very attractive. The issuing country issues the bonds to investors through their usual sort of sovereign bond issuance program. The investors hand over the money, and then the crucial first thing to note, of course, is that money can be used for anything. So you can fund education, you can fund armaments, you can fund sort of hydroelectric power, you can fund repaying other bonds that you've issued previously. Whatever you like, you can use that money for as part of your normal treasury operations. The key things, of course, you will need to add on top is you have to have a sustainability target. In this case, deforestation. Now, a country like Brazil already has a very strong mechanism for measuring deforestation. The current sort of presidency is less in favor of achieving a reduction in deforestation, but they have a lot of technology around measuring it. So that would be very easy. They could measure it, they could get third-party verification, and then they could very easily report against their performance. And at a point in time in the future, that would sort of trigger a check. Have we met the target or not? If we haven't, the coupon steps up. If we have, maybe the coupon steps down, and that flows through to investors. Very straightforward. So what are the advantages of a deforestation-linked sovereign bond? One of the crucial advantages, just like a sustainability-linked bond in general, is that the government, the issuing government, is financially incentivized to structure its economy to achieve this target. So aligning subsidies, tax incentives, getting its environmental ministry properly geared up to actually enforce deforestation sort of protections. Citizens and businesses have an indirect stake in success. The DLSB itself provides clear evidence that the issuing government is serious in its intentions. So it's much, much better than just saying, oh, yes, we'll reduce deforestation to 0 by 2040, because you're actually effectively putting your money where your mouth is. And you'll probably get benefits in terms of strengthening sort of civil society mechanisms around the edge as well. So there are a number of strong advantages that could flow from issuing a deforestation-linked sovereign bond. There is something else that's worth considering as well, and that is in the context of a country like Brazil, where there's a reasonable argument for saying, well, we're effectively performing a global good by looking after a forest like the Amazon. The rest of the world should be giving us a hand here. Well, you could actually combine a DLSB with an aid package. And again, both of them would sort of mutually strengthen the other, as we can see on the following slide. So here we've got exactly the same chart as before, but this time we've got an aid agency thrown into the mix as well. Now, there are a whole range of different things that you could do with this, but one of the crucial things that you could do is if the country fails to meet a deforestation target, the penalty, the sort of like the top slice of the coupon, goes to the aid agency. So the aid agency actually gets extra funding, which will then flow round to help to ultimately mitigate the harm that has failed to be mitigated at this stage. Conversely, if you succeed in meeting your target, then in theory, you would normally be asking investors to take a bit of a hit in terms of their yield, in terms of their coupon. Now you don't need to, because the aid agency will make up that gap. So they will drop money into the issuing country via the bond, and therefore investors will receive a flat coupon, which might be a much more attractive investment vehicle from an investor perspective. They might prefer that straight coupon rather than something a little bit more complicated. So you increase the attraction to investors, you increase therefore the potential investment pool, the money coming in and the liquidity thereafter, and you've now got this strong governance link to the aid agency and what it's actually trying to achieve. So quite a lot of potential advantages by linking those two things together. So that's the first example that we wanted to talk about. So a bond issued by a sovereign linked to a specific sustainability target, in this case, deforestation, and could also be tied into an aid package as well to give you that sort of that double benefit and the improved governance from both sides. So what I'm going to do now is hand over to Francois, who's going to talk about a corporate example in the context of a blue recovery bond. So, Francois, over to you.
Thank you, Peter, and thank you, Simon, for the invitation. Yes, as Peter said, rather than talking about another sovereign example, I'm going to mention a corporate example, and rather than being on land, we'll be looking at the sea. We call this example the blue recovery bond, and on the next slide, I will explain what it's about and why it would be needed. So just like Peter's example was about addressing deforestation, the point of this blue recovery bond is to address overfishing. As you might all know, this is an urgent need, given that demand for seafood is expected to double in the next 30 years, even when already 90% of global fish populations are either fully fished or overfished. So as a consequence, wild catch production, so the revenue for fishing companies, if you want, is expected to decline slightly every year by the FAO. And at the same time, the cost of fishing is rising, especially these days, by the way, given where fuel prices stand. So on the next slide, we argue, and we're not the only one clearly, that a period of restraint is needed. What do we mean by restraints? Well, let's start first by looking at the chart on the left. This crudely model a business as usual scenario, where you can see a change in fish stocks, or fish populations actually, that's the green line at the bottom, a change in wild catch revenue, and fishing effort in orange. Fishing effort is effectively the cost of fishing. So it's not looking good. But the good news is that under the right conditions, the health of the ocean, and therefore commercially fished stocks, can recover, and can recover pretty quickly actually. There are many examples of temporary restraints, that paid off. For instance, there was a rebound in fish stocks during World War I and World War II, following, of course, a marked reduction in fishing. After the collapse of the Soviet Union, the health of the Black Sea and the Adriatic Sea also significantly improved, thanks to actually the reduction in fertilizer application and the leakage into the ocean that is detrimental to ocean health. But without going as far back as to such extreme example, if you just look more recently in South Africa, a national park whose name I will butcher, but Tsitsikamma, I think, which is one of the oldest protected marine areas in the world. If you look at the density of commercially important fish, it's about 42 times higher in the park than in nearby fishing ground. And just perhaps as a last example, if you look at basically the productivity of fishing just outside an area of marine protected areas in the waters of St. Lucia, after this area was protected, that productivity, if you want, increased by up to 90% in just over 5 years. So all of that to say that if you leave fish alone for just a few years, they reproduce, and depending on the species, they reproduce very quickly. So the next slide will explain more about the blue recovery bond. So starting from the point that a period of restraint is necessary, this is how actually this instrument would work. I'm saying would because right now it is still a concept. It is not, a commercially an instrument that you could invest in as we speak. But I'll explain. I'll give you an update of where we are later on. So here's how it works. Fishing companies would accept a voluntary decrease in the quantity of fish that they catch for a set period of time. Now, of course, immediate pushback will be, well, they will never accept that because, of course, EBIT and free cash flow at this company would decrease. But, and this is the key part of the concept, the difference between business as usual and with a reduced catch, the difference in free cash flow would be financed by investors. provided that fishing companies demonstrate that they're fishing at the agreed reduced capacity. And when there's sufficient evidence that fish stocks are recovering, companies would be able to fish at a higher level again, but no more than what we call the maximum sustainable yield of each fishing stock. And then investor would cease payment. How do fishing companies repay investor? Well, some of the cash invested would then be repaid in the form of a coupon, which we think should be computed as a function of the wild catch volume until the bond's maturity. And what happens in case of failure? So if fish stocks are not deemed to be sustainable, if the recovery did not happen, for instance, I don't know, if fishing companies would have cheated, for instance, and still caught more, well, investors would have lost their money or part of the money, depending on the agreement. And if fishing companies cheated, so if they fished more than what they were allowed to, they would have to refund the cash received. Again, all subject to contractual agreements, but that's in a nutshell, that's the concept we had in mind. So if we go to the next slide, just showing one chart explaining a very simplified, as you can see, a simplified modeling of this example. We modeled it at the global level. So clearly it's very theoretical. And with what we computed is that for this period of restraint to achieve a result, we would need about $7 billion over 5 years. And that's the pale green bars on the left. If that money was somehow raised, investor in this blue recovery bond could trigger a recovery in fish stocks while securing a high return on investment. And that's because the fishing companies would pay coupons, which are the dark green bars that you can see. And fishing companies would also be in a better financial situation after 8 years. That's the orange lines that you can see. In case that sounds interesting, you can actually go on our website. We have a dashboard section, and you can play with these different assumptions to see how return would change, how fast fish population would recover, how big returns would be for investors, etc., etc. If you go to the next slide, we'll talk about benefits. Benefits of this instrument. There are many. Of course, that's why we're here. As my simplified modeling showed, actually it is an opportunity to align the interests of fishing companies, investors, and fish populations, and also the ecosystems that depend on them. It's quite a rare thing if you think about it. It's also a very rare but very much needed way to incentivize corporates and investors to reduce overfishing. Right now, there is a financial incentive to fish as much as possible because this is the way to generate cash from natural capital. So by reversing this incentive, you basically ensure that this natural capital is protected or at least less impacted. It can also be done in a way that optimizes the capital structure of fishing companies, by the way. So if some of the oldest and most capital intensive vessels, for instance, old bottom trawlers, are retired, the overall capital employed of fishing companies would diminish and therefore returns on capital employed would increase. One of the key requirements is increased monitoring, and I'll detail this very soon. But by allocating a portion of the funds to increased monitoring, you actually also reduce the risk of illegal fishing. So quite a few benefits here. Now, of course, there are challenges, as we'll see in the next slide. And as I've just said, monitoring is a key one. Without adequate monitoring of fishing activity taking place in the area, this cannot work. And for that, the necessary regulations must be in place, they need to be enforced, and adequate funding for this to happen is needed. Agreeing on the rules that would underpin this instrument is not also the easiest thing. For instance, agreeing on the level of reduction in fishing activity would be challenging, especially if many stakeholders are involved. And because it might be that many fishing companies are involved, there might also be the need to find an intermediary to act as an issuer for the bond, which overall can increase overall complexity and the length of the negotiations. And lastly, just to be upfront, there can be also unintended consequences. For instance, it might be in the interest of equity investors in fishing companies to support such a deal, but existing bond investors might not like it. Another thing to think of is that reduced fishing output for a few years has consequences further down the chain. It can affect processing activity. It could well be that processing companies would not support that. Could also affect employment in typically processing companies, but also fishing companies, and food availability. So all of that to say that the areas, species, companies that need to be chosen for such an example need to be chosen very, very carefully. And for all of these reasons, we're actually in the process of designing a robust framework to identify where and how such a structure could work. So actually the methodology, we have it already, and we expect to use it to identify actual fisheries where this would work by the end of the year. So please keep in touch. We can be in touch if that's of interest, Simon. And yeah, that was about the blue recovery bond. I let Peter conclude, and thank you for your attention.
Thanks very much, Francois. So yeah, I mean, in conclusion, I guess we should say, if we're being honest, that nature-based finance is a sort of an early stage market, burgeoning but very promising. We believe, as you can tell from these two examples, that there are lots of opportunities to structure financial instruments in a way that will actually benefit nature, and that links to those improvements in our natural environment. Key to that, policymakers. Policymakers will need to support nature-based instruments. I mean, Francois talked about a corporate example, but in reality, it's almost certain that you would need some sort of government or NGO type involvement to create the sort of the framework and the space for these bonds to operate really effectively. And he mentioned monitoring, so did I. All of these sustainability sort of linked, these nature-based financial instruments, they all require monitoring, because ultimately the purpose is to see an improvement in the natural environment, and you have to be able to demonstrate that that's actually taking place. Otherwise, it's greenwashing, and monitoring costs money. So there are potentially higher costs involved in these instruments than would be the case of a sort of straightforward financial instrument. And that also goes back to sort of the size and scale of the project that would really be required to make these work. And that point about sort of scalability and replicability are key to a developing market. So, you know, we've seen simple examples like, well, we've seen examples like a rhino bond, for example, which has been designed to benefit the rhino population in parts of Africa. But it's a very sort of specific, quite local, quite small. What we're really looking to do is to encourage things that are much bigger, and that, you know, if Brazil did a deforestation sovereign bond, then so could Indonesia, and then so could another country like maybe Canada, and so on and so forth around the world, because the structure would work in a variety of different places. So lots of things to think about. Thanks very much indeed for your attention. There's still time for questions, so I will hand back to Simon.
Well, thank you very much, chaps. That was a really fascinating talk. I can see that you've really engaged our audience. We've got a lot of questions from them. So I'm going to forego Chairman's privilege of asking the first one and dive straight into our audience questions. And the first one I've got here asks if there are any specific nuances or differences for the credit ratings of these particular bonds.
Yes, that's a good question, and I guess because nobody's done one yet, it's a little hard to answer that question from a practical perspective. In theory, if you take a deforestation, well, let's maybe take the blue recovery bond, because I think sort of structurally, in some respects, that's a bit simpler. You have a set time frame. You've obviously got question marks over the cash flow, but in terms of sort of, you know, the underlying credibility of the payers, well, that would be just like a normal sort of credit modeling operation. The actual payback structure is a slight complication, but again, nothing that can't be modeled. And really the same is true of a deforestation-linked sovereign bond. So the credit rating is going to be Brazil or Indonesia or Canada or whoever. There's no difference there in terms of the credibility of actually getting your money back. The only difference really from an investor's perspective is quite how the cash actually flows to you. And as I say, if you combine it with an aid package, then you've got a straight sovereign bond with no questions asked, as it were, in terms of the coupon, but with the added benefit that you as an investor can say, this is a sustainability linked investment, and I can put it into my sort of green portfolio. So that would be the advantage. So no, I think actually from a credit perspective, credit rating perspective, not really any significant changes, to be honest, to the normal modelling.
Absolutely. Which organisations, I mean, both you and Francois mentioned monitoring and external verification and adjudication. Which organisations are stepping up to actually act as these third-party adjudicators, and how do you actually validate their independence?
Yeah, Francois, you've got examples from the ocean side.
Yeah, I guess it depends. It would be a case-by-case basis, really, literally. So in oceans, if we talk about fishing, it depends what we mean also by monitoring. But in the case of, let's say, a fish stock population, it would be some fishery agencies would effectively tell you, well, the companies report the level of catch, and this is all verified by third-party agencies. So that's something that could be done. That's referring to this example we had in mind. You also have third-party certifiers. So the MSC, Marine Stewardship Council, is I think an NGO that many of you will know that certify whether a fishery is sustainable or not. They would also rely on third-party certifiers that are independent. So it very much depends on the case-by-case basis, really. I think Peter before alluded to the rhino bonds, which effectively help increase the population of rhino in several sites in South Africa. Here, monitoring means effectively ensuring that there's no poaching of this rhino. So monitoring here means paying rangers on the ground to ensure that this is not happening, that they are not getting killed. So monitoring can be many different things. Maybe Peter has a better, some additional thoughts in the case of Brazil, where monitoring deforestation, I imagine that was the basis of the question, could be something more challenging and political.
Yes, and it's a good observation. I mean, I think there are a couple of sort of strands to the answer as well. You know, there are organisations like Sustainalytics, for example, which is part of Morningstar, which has set itself up to provide sort of verification and monitoring of ESG-labelled bonds in general. So there are a number of organisations that are selling a commercial service, like sort of audit function, if you like.
There's also been huge advances in remote sensing as well with regards to deforestation, Peter.
Exactly, that's right. And I think actually deforestation in some respects is easier than fish stocks because you can see a plot of land. And, you know, we've got satellites that just on a commercial basis can sort of, you know, zero in to sort of, you know, 3 meter square sort of pixels or whatever. So you can absolutely tell what's going on. The challenge often is to find out who's responsible. That tends to require human beings driving around in sort of, you know, Toyota Land Cruisers or whatever, or drones rather than satellites, because you need to get down to a more what you might call grassroots level. But yeah, I think the technology very much exists in a lot of these situations for independent sort of third-party oversight. And also we have a number of organizations that are actually selling a commercial service in terms of the verification and reporting. So the structures already exist.
Now, with regards to sustainability-linked bonds, commercial sustainability-linked bonds issued by corporates have been around for a few years. Is the sense that they tend to be held to maturity, or is there a secondary market for this type of bond? And can you see the same thing happening with nature-linked sustainability-linked bonds?
Yes, that's a good question. I don't have the data to hand. My sense is that, you know, there is a secondary market. Definitely, they're sort of, you know, they're traded and quoted in the open market, just like, you know, a number of other bonds. And in fact, sustainability-linked bonds are becoming more and more popular as issued sort of tools for corporates because they don't restrain the use of proceeds. So the sort of the liquidity, the size of that market is really growing very dramatically. if you are a pension fund, if you're an asset owner, there's a lot of attraction to holding these things to maturity, obviously, because you can get the sustainability benefits in your portfolio all the way through the bond's life. But no particular reason why, just like an inflation-linked bond, some people will buy them for that long-term hedge. So some people would want a sustainability-linked bond for long-term exposure to the particular sustainability issue. Others will be buying it as an ESG instrument for their ESG portfolio, but they'll be trading it just like any other bond investor would do.
Now, this is an interesting question. This particular question is asking why there's no sign of this sort of bond in the UK, but I'd actually push that broader. As you know, Chile have issued the world's first sovereign sustainability-linked bond in May of this year. They're focusing very much on climate change. They've got a target, I believe, of 60% of the country's energy being produced from renewables by 2030. Is there a sign that sovereign sustainability-linked bonds are going to take off? And do you think this is perhaps of more interest to developing economies than developed economies in Europe and North America?
It's a good question. I think politically, North America, if you're talking about the USA, it will be a heavier lift. I think in terms of Europe, particularly if you look at things like energy transition, it's quite clear. For example, the UK has a growing energy problem. So if, for example, we wanted to insulate all our homes properly, the government could definitely issue an insulation-linked bond to achieve that. So I think there are lots and lots of possibilities that come from sustainability-linked bonds because you're tying them to sort of KPIs that you will want to achieve anyway. So there's that alignment of motives, and the proceeds don't have to be spent on specific projects, which gives you that sort of treasury flexibility. So yeah, I think these bonds will grow and grow in popularity. As I say, the corporate side of things, they've really moved fast. Chile, as you say, has led the way. There are definitely other countries talking about it. Pakistan has been talking about it for some time, but has not yet done anything. But there's absolutely no reason why it should be a sort of developing market, the emerging market instrument. Easily possible for countries like the UK, institutions like the EU to do it.
Now there's a very interesting question here talking about benefit distribution with respect to indigenous people. Certainly with regards to deforestation, indigenous people are going to be affected either positively or negatively. How do you actually incorporate their interests into this type of bond? Francois, you mentioned the downstream effects with regards to fishing. What are your thoughts on the rights of indigenous peoples?
Yeah, I think here it depends on what is meant by rights. If you step back a little in terms of fishing, a key way where local communities are affected by industrial fishing right now is simply through competition, basically, right? And the fact that they can't, artisanal or sustainable ways of fishing are harder to achieve because basically there's not enough fish close to the coast. So in a way, the simple fact that a period of restraint would be put in place is already an help. It is not. We're not talking about indigenous rights here, but that's already something to think of. Because for the sea, it is harder to think in terms of rights, if you want, at least past the 12 nautical mile zone. What I would say though is there are examples in the US where fishing, let's call them quotas, are allocated specifically with a priority rank to certain local communities. Basically, Native Americans have some priorities for some fishing quotas. So that's something that could be designed and replicated in other parts of the world as well.
Excellent. Ladies and gentlemen, I know that there are still some questions outstanding. We will pass them on to our speakers so they can correspond with you directly. I'm afraid we have run out of time for today. we're going to be posting or recording this presentation online in the next couple of days so that you can revisit what Peter and Francois have said. It just remains for me to thank the members of the FS Club for making today possible. I'd also urge you to keep an eye on our forthcoming events page for more webinars, which in the near future include Bangladesh trade development and prospects in the emerging Asian European supply chain, which is taking place on the 9th of August. What does an information commissioner do on the 10th of August? And Trust in AI, rethinking future command on the 11th of August. You can catch up with all our previous webinars on YouTube or our new Pizzazz TV channel. We hope to see you again soon. Thank you very much for attending. Goodbye.
Thanks very much, Simon.